I didn't realize that whole loss of 3.7. I only realized a 1.2% loss.
Mm-hmm.
Okay.
And this is
So
the starting point, right, Kurt? This is how you start any trade, is by purchasing stock and purchasing protection set up based on the specifics in the blueprint.
Right. That was a trade that went wrong. It went against me, and I ended up losing 1.2%. But if a trade goes your direction, why then you can do well. You see, the major portion of this is ownership of stock. If the stock moves in the direction that you like, well, you're going to still make money. If it moves against you, you are spared from the debilitating losses. And you know, I think I asked the example of 6%, but what if it was 1.2%?
Mm-hmm.
I mean, what if you lost 1.2% on your losing trades last year, and yet you allowed your winners to run? Would that make a difference? Probably. Okay. The red zone, of course, is where losses could go without the put. This break-even line here, Mike, in other webinars, we have shown that this maximum loss, we never have to realize the full maximum loss. But even so, if we set it up to be 6%, that's pretty good. Now, this break-even amount, the stock does not have to approach that before we're bulletproof, does it?
No, that break-even line that you're looking at, that's really only the break-even. If we held the position all the way out to expiration, and you're going several months out in time with your insurance, and if you made no adjustments, what we typically see is we have a curved line on top of this that shows us what would the profit and loss of our position be, let's say at the halfway point, or in a couple weeks, or in maybe a month. And the break-even is much lower because the time value of the put still holds. It still retains most of its time value over a 30 or 45-day time period.
Right. I've endured a bit of criticism because I buy a put option that's higher than the actual price that the stock is trading at. And that criticism has been, well, Kurt, you can't make any money until the stock goes, you know, above that break-even point. And we've actually proven that to be untrue. I've been able to bulletproof things way before they even reach that. Even guarantee myself a return before the stock even reaches this break-even point. Okay, but here's what I'm going to do, Mike. Just before we get into some details, let's just compare the ownership of 3 different positions. Okay, straight stock, a covered call trade, and a married put. Okay, now the straight stock doesn't give us any protection, and it also doesn't give us much premium. Okay, unless of course you're collecting dividends. If your stock goes up 20%, then the straight stock play yields 20%, right?
That's right. Mm-hmm.
What do you expect with the covered call play? Will we still make money?
Oh, of course. If we had a stock and a covered call and it went up 20%, we'd still make money, but we're not going to realize that full 20%.
Yeah, we're going to make less because we're going to collect some premium. The stock's going to go up and get called away. Okay. What about this married put play? Okay, we're going to cut into our profits a little bit by buying the put, right?
That's right. We're taking a long stock position, and we are doing a bearish hedge against it. We are adding a bearish position on top of it and paying for that. So if the stock moves up 20%, we might not realize the full 20%, but we still have an unlimited upside profit potential.
Right. All 3 of these plays make money, all right, and they just make money in different ways. So let's say we take our winnings from that and we put it into a new play. Okay, but this time the stock goes down. Well, with the stock, we're going to lose 20%. Are we going to lose less or more with the covered call play?
Well, we're going to lose less because we did collect premium, a little bit of premium to hedge some of the loss, but we're still going to lose. We still don't have any protection in place.
Right. What about that married put, the way that I've shown how to structure it?
Well, we put in that floor, the 5 or 6% limited risk, that we can't lose more than that amount when we originally opened the position. So we may have a loss of 5 or 6% on the married put when the stock dropped 20.
Okay. So, Mike, here's what I want to know. We had the same stock, and we played it 3 different ways.
Mm-hmm.
All right? And then we had another stock and played it three different ways. All right? And when we make 20% and then lose 20%, where does that put us?
Well, we're not at break-even, are we, Kurt? We're in a much different scenario, much worse scenario if we make 20% on a position and then lose 20%.
Yeah, most folks would look at, making 20 and then losing 20 and say that, well, that's a wash, but it's not, okay? It's a net loss, and here's why. 20% win. Say you had $100 and you won 20%, okay? Then you'd have $120. Now, taking that $120, a 20% loss, 20% of 120 is $24, right?
Mm-hmm.
So you end up behind. And that's the way math really works, okay? All right, how about this, the cover call play? If we limit our upside and still have losses, well, it's going to be kind of backwards. If we make the 5% and then lose the 15, we're going to end up behind the 8 ball, okay? What about the married put play? We made less when it went up, but we lost a whole lot less when she went down,
Mm-hmm.
okay? So we make 15% on the way up, get into a new stock, we lose 5% on it. Okay, Mike, we're going to still be ahead. Now this was the same stock in the same market, but different end results for the 3 strategies.
Mm-hmm.
Pretty cool? Okay, I'm going to say that cutting your losers short is the ingredient that most people miss. And that 94%, we had 6% say, well, I'd still be unhappy. And 94% of our audience in one way or another said, I'd be better off if I'd have done what you said. Isn't that right?
Yeah, if we just focused on limiting the risk first rather than the returns, we would have been happier over the last 12 months.
Right. Okay.